Welcome to Chapter 5. We're gonna continue our travel around the accounting cycle, and in this chapter we will cover adjustments and the worksheet. So these are your 5 learning objectives for the chapter. I will introduce a 10-column worksheet. We will complete a trial balance on the worksheet. Then I will talk about calculations for 3 types of adjusting entries. We will complete the worksheet. Then you will prepare financial statements from the worksheet, and we will take our adjustments from the worksheet and we will put them in the journal and then post them to the ledger. All right, so the worksheet, it's a 10-column accounting form with 2 functions. We use it to figure out the adjusting entries, and the second function is to prepare financial statements. I want to emphasize that this is a tool rather than an official report. It's really an optional step of the accounting cycle. It's only going to be seen by the person who prepares it, and I think of it as a hub of all accounting data put together. It looks massive, but it's very easy to do. For our textbook, it's step 4 of the accounting cycle, but again, as I say, the preparation of the worksheet usually is optional, and if we decide not to prepare it, in step 4 we simply prepare the trial balance before adjustments. So again, this is step 4 of the accounting cycle. We are right now at the end of the period. So this is the end of the month. We've done steps 1, 2, and 3, and now we're going to do steps 4, 5, and 6. So this chapter, chapter 5, focuses on steps 4, 5, and 6, and the next chapter will conclude our accounting cycle with steps 7, 8, and 9. So this is how the worksheet looks like. We've got with you the account name column, and then we have 5 pairs of money columns. The worksheet has, of course, the title with who, what, and when. And the money columns, like I said, there is a 5 pairs of debit credit. So together there are 10 money columns. That's why I call it a 10-column worksheet. We have a trial balance, and I want you to think about it. We can refer to it as unadjusted trial balance. The trial balance we prepared in chapter 3 before we record adjustments. Then we have 2 columns for adjustments, debit and credit. Then we're going to combine trial balance and adjustments into the adjusted trial balance, and then we're going to split the adjusted trial balance and have data for the income statement and the balance sheet. So how do we prepare the trial balance section? In 4 steps. We're going to copy account titles from the ledger. We're going to list them in the same sequence, and at this point some of the accounts will not have any balances. We're still going to list them, and then we're going to transfer the general ledger account and balances to the debit and credit column. So we just pretty much copy all accounts and their final balances from the general ledger to the trial balance columns of the worksheet. Then we're going to total the debit and credit columns, and we're going to prove that the trial balance is actually in balance, and then we're going to double underline both totals to show that the column is complete. So here we are. So we entered all of these accounts in the same sequence. So you have assets listed first, but notice there are some new accounts that you have not used yet, such as accumulated depreciation equipment, and this account currently has no balance. We're still going to list it because it's going to be impacted by adjustments. And then you have your liability accounts payable, your capital and drawing, 1 revenue account called fees income, and a couple of expenses that will have balances, and then you will have 3 new expense accounts that do not have balances yet, but we need to list them. So I transfer all of the balances. So if cash has a debit balance on the ledger of 111,350, I put it in the debit column and do the same for all accounts. So if you look right now, these are your assets, this is your expenses, this is your drawing. A, E, D. They have a normal balance on the left, or debit balance. A, assets, E, expenses, D, drawing. or we remembered it in our mnemonic device as after eating dinner. And then we have liabilities, revenues, and capital, LRC, let's read comics. And those types of accounts have a normal credit balance. The balance is on the right of their T account. And when we total it up, we can see that my debits are equal to credits. So this is the trial balance that we prepared as a separate form in chapter 3. So you do either or. If you prepare the worksheet, you prepare the trial balance on the worksheet. If you choose not to have the worksheet, then you prepare the trial balance as a separate form. So we prove that debits are equal to credits. So now we're going to talk about the core of this chapter, and it could be challenging. These are adjusting entries. We have not seen anything like that before. These are completely internal transactions. They do not impact cash. There is no exchange of anything with any outside party. Every single transaction you saw in chapters 2, 3, and 4, every one of those transactions was considered to be an external transaction. We involved a party outside of the company. We performed services for customers, and customers paid us. Or the owner, which is the entity outside, invested money into our business. Or we paid salaries to employees, involved employees. So all of those transactions were easy to keep track of because they had some kind of source document, an invoice, a check number, a sales slip. Internal transactions are very easy to miss because they're just internal to our business. We're just taking care of our records. And we have our trial balance, but some of the accounts in the trial balance, some of their balances are not ready yet to prepare financial statements. We're gonna need to think about adjustments. One example here will be supplies. So if you look at supplies, you remember that every time we purchase supplies, we were not allowed to expense them. So we put them as a debit into the asset account supplies. But now it's a month later. Do I still truly have $1,500 worth of supplies left? I have to actually look at my supplies, do the inventory, and see, well, how much of this $1,500 is gone? How much of these supplies have we used up? And whatever amount we used up, we need to adjust it. So we need to move part of the supplies that have been used up into the account supplies expense. So we will decrease our asset supplies and we will increase our expense. Again, there is no cash. I already purchased the supplies. So my adjustment will debit increase the supplies expense account and credit decrease the supplies. So all three types of adjustments, and there are dozens of types of adjustments. So in this chapter, we're just introducing the first three types of adjustments. There are many more. They're covered in chapter 12 of this class. And also you talk a lot about adjustments in Business 1A Financial Accounting. So here, we're just pretty much all three types of adjustments. We'll be looking at how much of the asset have we used up. And whatever part of that asset we used up, we will move it to the expense account. We will debit always, in this chapter, every adjustment, we will always debit some sort of expense. So for adjustments, all three types, we will debit an expense, which will increase it, right? So part of the asset is used up, so expenses go up, and we will always credit some kind of asset or contra asset, which will decrease the amounts of assets. So it will be some sort of an asset decreased. And as a result of this adjustment, what happened with my income statement? So on the income statement, we list with you revenues minus expenses equals to net income or net loss. So my adjustments, all of them, will increase the amount of assets, right? So this asset, the amount of expense, increase the amount of expense. These expenses go up. So what my adjustment leads to is to higher expenses and therefore lower net income. So if I forget to make an adjustment, my expenses would be or understated, too low, which would make my net income too high. So what do adjustments do? They increase expenses, which in its turn decreases my profit. And as an owner, you actually really like this adjustment. It has nothing to do with cash. You paid your cash anyway. So your lowered net income actually results in lower taxes. And on the balance sheet, what happens? We will always, with adjustments, so my balance sheet is assets equals to liabilities plus owner's equity. So what adjustments do, they decrease assets. I have fewer supplies, I will have fewer prepaid rent, prepaid insurance, right? So my assets would go down. And because my net income is down, my equity will be down. So my balance sheet, both sides of the equation will be a little lower. And if I forget to record an adjustment, my assets would be overstated and equity would be overstated. So there will be questions on your quiz. If you forget to record any adjustment in this chapter, what happens? If I do not record an adjustment, my net income, my assets, and my equity would be too high. They would be overstated. So these three pieces of financial data would be all overstated. Okay. So adjusting entries going to be first entered in the adjustment section of the worksheet. We're going to enter them here, work our way through, prepare financial statements, and then we will go back to these adjustments in step 4 of the accounting cycle. And we're going to take them from these 2 columns and we're going to journalize them and post them to the ledger. So 3 types of adjustments. The first type of adjustment is in regards to supplies. I already mentioned it. So again, if you look back, you will see that in the trial balance, we had $1,500 worth of supplies. At the end of the month, we do the inventory, or we estimated only $1,000 of supplies remains. So when you do the adjustment, the first step, think about math. Do not worry about debit accounts and which account to debit, which account to credit. So I always say do the math. And the question here is, well, how much of the supplies have I used up? How much of the supplies should I expense out? And it's the difference here, right? So how much of supplies is used up? $500. And the second step, you debit some kind of expense and you credit an asset by $500. So first step, worry about the math. And sometimes the math is done already for you. Sometimes you have to figure it out. And as you can see, the math is quite easy. So 1,500 minus 1,000 of supplies which are still on hand gives me $500. The dollar amount of supplies was used during the month is $500. What do I do with $500? I put it as a debit into supplies expense, because it's now gone, used up, and I put it as a credit in the supplies. And if you think about the supplies account here, right, I always like to draw out the T account, you know that. So my supplies had a balance of 1,500 before adjustments, and then when I adjust them by 500 credit, what does it do? It's a negative for supplies. So what will be my ending balance of supplies, adjusted balance of supplies? It will be $1,000, and that reflects how much supplies is actually left. Where will I see it? I'll put it right here, right? In my adjusted trial balance, it will be $1,000 left, and that's what will go on the balance sheet. So if I don't make an adjustment, then the amount of supplies on the balance sheet is too low. I'm sorry, the amount of supplies on the balance sheet would be too high, overstated. Okay, so that's for supplies. The second type of adjustment is for prepaid expenses, and it could be prepaid rent, prepaid insurance, or prepaid advertising. The idea is the same. If you think about supplies, we pay for them first, we prepay them, and then we defer the use of supplies until later, so we expense them out later. So another fancy term for all these adjustments is deferrals. We pay cash first and we defer the use, and then later we defer the recognition of an appropriate expense account. So November 20th, LIs paid $8,000 for December and January rent. As of December 31st, 1 month's rent has already been used up. So do the math first. I prepaid $8,000 in November, and when I paid cash, I debited prepaid rent, which is an asset. And now I have used up 1 out of 2 months, right? I prepaid for 2 months, December, January. Now 1 out of 2 months is used up, which is equal to $4,000. That's the amount of an asset called prepaid rent, which is used up. Second step, debit rent expense, credit prepaid rent. So make sure you understand this. This is the dynamic here. Cash has nothing to do with adjustments. So again, what is my dollar amount of rent used during the month of December? It is $4,000. What do we debit? We debit rent expense. What do we credit? We credit prepaid rent. Again, in its philosophy and in its approach, the first and the second adjustment are very similar. We increase the expense and we decrease the appropriate asset by the amount of that asset that is now gone. Okay, and the last, third type of adjustment is depreciation, and most of you have heard about the word depreciation. You buy a new car and you drive it out of the dealership's parking lot, and your car at that moment depreciated, 10 to 15% of its value. So depreciation is the loss of usefulness. It's the loss of value for a long-term asset. It's only about long-term assets. So we're here talking about equipment, buildings, machinery. Supplies do not depreciate because they are not long-term. We assume we're going to use up supplies within 1 year. So we will depreciate all long-term assets with the exception of land. This is just a rule because land could be used forever, right? It does not deteriorate. The structure on the land, the building or the driveway or the machinery or your airplane, your truck, your auto, all of the physical long-term assets, they deteriorate. So they depreciate. Land could be theoretically used forever, so we will not depreciate land. So this is the fancy definition of depreciation. It's the cost is recorded as an asset and charged to an expense over the time the asset is used for the business. So think about you're buying a truck, you're paying $20,000 for it, and you're going to use it for 10 years. It would not be fair to charge $20,000 as an expense for 1 year. I will be using this truck for 10 years. It will help me generate sales and revenue for 10 years. So I should take that $20,000 and I should spread it over the life of the long-term asset. And I will depreciate it, expense it out every year for the remaining life of that asset. Now, depreciation could get very difficult and there are different methods to use. In this class, in this chapter, we're just going to simplify it. So this is your asset pie, a truck or a piece of machinery or tools. And every period, every month, you expense out part of it. And by the end, and so this expense is called depreciation. Depreciation is an expense, just like supplies expense or rent expense, but it's an expense for a long-term physical, tangible asset. And by the end of the life, a lot of that asset's value will be depreciated. So again, small business owners, or any owners, right? Any business people, they love depreciation. We love depreciation because it's really allowing you to write off taxes. It decreases the amount of taxes you owe. Again, you don't pay money for depreciation. You had already bought this truck. You already paid cash for it. It's just a decrease to your bottom line, to your net income, which allows you to pay less in taxes. So there are several methods of calculating depreciation, but we will use the simplest and most common method, and it's called the straight line method. And guys, this is the formula. It allocates an asset's cost in equal amount to each accounting period of its useful life. Hence, straight line. This is the formula you need to know. Cost, how much did you pay for this asset? So if I spend $20,000 for the truck, I put it here, it will be given to you. Minus salvage value, which is an estimation, it's an estimate. And for a truck, so if I'm going to use it for 10 years, what kind of residual or salvage value, if you use Blue Book, you know, for your car, it's a Blue Book value, salvage value after 10 years. So you estimate it, or the IRS has tables to help you estimate it. And guys, let's say it would be 20, so I bought it for 20,000 and the salvage value after 10 years will be 5,000. So the difference is 15,000 and you divide it by estimated months. So if I'm going to use it for 10 years, I would divide it by 120 months, right? There's 12 months per year. So if it's 10 years, I will divide it by 120 months. So guys, salvage value and the estimated useful life, those are both estimates. And guys, in higher level courses, we will talk about, well, can I change the estimates? What if I put a new engine in the truck? Will it increase the useful life? What about the salvage value? What if at the end of life, I'm actually going to get not $5,000 for this truck, but less than that or more than that? All of these issues will be taken care of in higher level courses. But for now, you just need to know how to calculate depreciation. So here's an example. We buy equipment in November. We're going to use it for 5 years, which is equal to 60 months. 12 months multiplied by 5 years. The cost is 11,000 and we estimate that the salvage value is 0. So for many assets, the salvage value will be 0. We believe that in 5 years, nobody will want this piece of equipment. So we calculate the formula cost minus salvage value divided by useful life in month. If I'm asked to calculate depreciation for 1 month. So we calculated and it's $183. Now this is my math. First step, do the math. Second step, debit the expense and credit the asset. But what happens here, we have an asset equipment. And if I bought it for $11,000 right here, I would want to, my natural reaction is when I depreciate it, I decrease it, I credit it by 183. And I do it every month, every month, every month. And after 60 months, my value, my balance will be 0. However, GAAP does not allow us to do anything to equipment. They say, once you bought it, you debited it at the cost of equipment, leave it alone. Do not touch it because you might forget how much you purchased it for. And so we are forced to come up with this new account. And this new account, you haven't seen anything like that. It's called accumulated depreciation dash equipment. Accumulated depreciation dash equipment. And it's a new type of account. It's called a contra asset account. Contra asset. So what it means, it's an asset. It always travels with the main account. So if equipment account number is 144, then accumulated depreciation will be 145. If I list equipment on the balance sheet, right under equipment, I will list accumulated depreciation dash equipment. They always travel together. It is a permanent balance sheet account. It's not an expense, but it's a contra account. So what happens with the signs, they just switch. And instead of normal debit balance, we have a normal credit balance. And I put 183, I credit this contra account instead of directly crediting the main asset account. That way, I always know what the balance of equipment, which usually represents my initial cost, what that is. And whatever I haven't accumulated, so it will accumulate, right? Hence the word accumulated. So every period, my balance of the accumulated depreciation account will go up. And after 5 years, my balance here will be $11,000. So what will be my book value? What would be the difference between the main account and the contra account? It will be 0. So another term you need to know what book value is, the value of the long-term asset on the books. It's your main account, it's your main asset account, such as equipment, minus its accumulated depreciation, or its cost minus total accumulated depreciation. So accumulated depreciation goes up every period it accumulates, book value goes down. And at the end of the life of the asset, the book value amount is equal to the salvage value. Again, stop and think about it. At the end of the life, my book value must be equal to salvage value. So if here my salvage value is 0, my book value at the end would be 0. If it was a different amount, if my salvage value was $1,000, then at the end of the life, the difference between main account and accumulated depreciation would be $1,000. So again, if this is confusing, rewind this part of the lecture and listen to it again, and of course practice. So here we are, right? I debit depreciation expense, which is an expense, and I credit accumulated depreciation, which is the contra asset. This is it. I have an adjustment A, B, B, C, 3 adjustments. I total each column. My debit is equal to credit, double underline. I'm going to stop here and we will finish the lecture for chapter 5 in the second part of the video. Thank you.